Ahead to 2025 and entering year 3 of a bull market, we're thinking about what the most important indicator will be around the health of the markets and the U.S. economy. One thing that might not be getting enough attention, though, is the 10-year Treasury yield. The yield recently moved higher, and here to explain is Yahoo Finance Markets and data editor Jared Blickery. And Jared, the Treasury market, it can sometimes be a little complicated, a little convoluted, confusing. Why should investors be paying close attention to that yield?
That is an excellent question. We have just seen bonds explode, or at least the yields explode to the upside, and it's critical to know that bond prices move inversely. That is opposite yield. So that means people don't want bonds, and that's why the yields are shooting higher. This comes after Chair Powell over at the Federal Reserve just came out with a lot more hawkish tone and statements that people expected. And so the thinking is that maybe rate cuts are in the rear view, that we've just had our last one. Maybe the Fed goes on pause in 2025, or the unthinkable that we get rate hikes. But I should note that that's just a remote point right now. So investors have fled the safety of bonds, and we have some critical levels to look at in the 10-year yield. I have learned a lot about the bond market from some of the guests over at Stocks in Translation. That's a podcast that I host, and we were talking to RBC's Robert Slimer on the show. He said watch 5% in the 10-year to the upside, because that means things are getting too hot. That would be animal spirits, inflation. And then he said to the downside, 3.25% is what you want to watch, because that could indicate recession. And we're right towards the upper end of that right now. Now I'm going to bring in another guest that we had, Joe Bruce Wallace. We know him well. He's over at RSM, the chief economist. And what he was saying, well, we have a clip of this. So let's get to that. It's going to be about what we should expect with the Trump trade.
Financial markets are going to be one of the real institutional checks on the economic populism that's going to be put in place here. Well, 2025.
The stock market has been the barometer of the first Trump administration. So
the bond market's likely to be the second.
So important point there. We all remember how Trump would talk about the Dow and the stock market and kind of use that as a gauge. I think the 10-year and specifically the bond market, or just generally the bond market, is going to be a very front of mind, top of mind thing going forward. And this has to do with all the pressures that Trump faces from higher yields. What he wants to do is generally inflationary, or what he's facing and walking into is an already inflationary environment. We have new tariffs. We have a new immigration policy. We have the continuing reshoring, bringing back businesses to the U.S. that sends prices up. We have higher spending. We have a record current account deficit. That means that we're importing a lot of stuff. We're exporting a lot of dollars. That drives the dollar higher. And so when we talk about higher yields, it plays in with a higher dollar. And as I've been talking about the last few weeks, the dollar wrecking ball is something that we need to pay attention to. So these